Good morning, everyone. Well, the dollar shrugged off a disappointing Philadelphia Fed index yesterday as risk appetite came back regardless of the numbers. The dollar rally began after disappointing PMIs from the Eurozone, and the dollar wound up gaining across the board, aided somewhat by a better than expected market preliminary U.S. manufacturing PMI, but just somewhat. The U.S. stocks rallied and bond yields were up 2 basis points. Now, markets are continuing their risk-on mode this morning as stocks are higher across Asia. As a result, the exceptions to the higher U.S. dollar were the risk-sensitive Aussie and Kiwi dollars, which gained along with the better risk appetite. Several of the beaten-down emerging market currencies also rose, such as the Brazilian real and South African rand. That's a good sign, and then it shows the growing chaos in Venezuela and Ukraine isn't spreading contagion throughout the asset class. It was noticeable, though, that gold and the other precious metals gained as well, even though there was clearly no flight to safety move. On the contrary, the risk-on sentiment means a higher dollar-yen in the first instance. Looking forward, it appears that the G20 meeting of finance ministers and central bank governors that begins tomorrow in Sydney isn't likely to come to any great decisions, which probably won't surprise anyone. Press reports say that the draft communique will concede that accommodative monetary policies, quote, will need to normalize in due course in line with stronger growth, unquote, meaning that the U.S. and eventually the U.K. isn't going to change course on tapering off its monthly bond purchases just to accommodate the emerging market countries. I expect, as usual, a communique filled with lowest common denominator bromides that have no lasting market impact. As for today, we've got UK retail sales for January coming out. They're expected to be lower. Since consumer spending is one of the main engines of growth in the UK, this could hurt the pound. Later in the day, we've got Canada's retail sales for December. That's also expected to show a decline. We saw the Canadian dollar weaken sharply on Wednesday after wholesale sales fell further than expected. So a decline in retail sales in December could hurt the currency as well. From the US, existing home sales for January are expected to have fallen month on month after rising a little bit in December. Now, we've seen a number of disappointing housing-related indices recently, and actually they haven't affected the dollar very much, as people assume that the slowdown in housing is due to the unusually cold winter. So this decline in existing home sales, too, might not have much impact. Although, of course, you don't have to build an existing home. By definition, it's already existing. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.